In this example, we are looking at the specific identification method in calculating our ending inventory and our cost of goods sold. So the specific identification method is just a method that businesses can choose to track the costs and sales of their inventory. So in this example, you can see what happened through the month of August. We started August with a beginning inventory of 40 units, and we paid $10 per unit. And then we had another purchase on the 8th and another purchase on the 22nd. And you can see our cost changed during each of those purchases. First we paid $10, then we paid $11, and then we paid $12. So the different inventory methods that we're going to go through help businesses account for the variations in those costs. And then it also says that we had some sales on August 15th and the 28th, and it tells us how many we sold and how many units we sold. Then it says to assume that the inventory consists of 30 units from August 8th, from the August 8th purchase, and 25 units from the purchase of August 22nd. So here's kind of what's going on. This represents here everything that we had available to be sold. That means we had 125 units of inventory that we could sell, and the cost of all of those units was $1,370. Then we sold some units, which left us 55 units in our ending inventory. And what's important at this point is not the date of the sales. What we're more concerned with is always calculating our ending inventory, which then helps us calculate our cost of goods sold. So this is the formula that we're going to use to calculate everything. Cost of goods available for sale, which in this case is this 1,370, less our ending inventory, which has to be calculated, gives us our cost of goods sold. It's as simple as saying our cost of goods sold is equal to what we had available to sell, what we could sell, minus what we did not sell, what we had left over. So let's do that. So under the specific identification method, we are assigning and tracking each unit individually. We're not lumping everything together. So first, to follow this pattern here, cost of goods available for sale is this 1,370. We took all of our units times what our cost was for each of those and added them up. Now we have to calculate our ending inventory. And it tells us here what our ending inventory consists of. It says 30 units from the August 8th purchase. So I find my August 8th purchase, and it was $11 per unit. So I have 30 units that cost me $11 per unit, still in my ending inventory. It means I haven't sold it. And I also have 25 units for my August 22nd purchase, which I paid $12 for. So 25 units times $12. We add that together, and that gives us a total ending inventory of $630. So then when I put it into the full format, cost of goods available was 1,370. The cost of my ending inventory was $630, so that means I sold $740 for my cost of goods sold. Now keep in mind, that's not what I sold it for. Those aren't my sales. That was my cost of those sales.